How to build wealth. There are a few key principles to building wealth. Wealth building is important in any age and can be done whether you are 18 or 60. Staying wealthy is not so easy either. Today we will go over key principles from the book Cashflow Quadrant by Robert Kiyosaki. To understand how to build wealth, we must first understand where you are as of right now. If you want to take control of what you do today in order to change your financial situation, this video will help you. Kiyosaki separates people into 4 categories: E, S, B, and I. E stands for employee. A person who has a stable job and does it every week. S is specialist or small business owner. Reason why an employed person and a small business owner are in the same category is because of 2 reasons. First off, tax bracket, and secondly, they tend to work and do everything alone. B is for big business. This means tens and tens of employees and workers. I stands for investor. Investor can be categorized also in many ways. Kiyosaki tends to take investors as people who invest into startups, new businesses looking for capital, hence high risk, high return. Some examples are Volt, Uber and DoorDash and such, but in a phase where they are worth less than $10 million. It is possible that you can be in 2 cash flow quadrants at the same time, for example E and I. Which cash flow quadrant are you in? The book states that to build wealth, the only option is to move from E and S to B and I quadrants. But in reality, it's not so strict. You can make $40,000 a year and still build wealth. Let's say you save 10% per year. At the end of the first year, you have $4,000 to invest. Second year, $8,000 and so on. What's important to build wealth is to use taxes in your favor. Do not avoid paying taxes, but use the tax code. Most of the countries have some tax reliefs for personal or business income tax. Look into it depending on your country and state. Quick Googling or tax consultant can help you out. Kiyosaki states that easiest and best way to build wealth is through real estate. You can use leverage for real estate and so have small amount of initial capital. Taxes are what can destroy your wealth building. If you can average 10% yearly returns but pay 20% taxes, you will grow a lot slower. Usually, the best option to build wealth is to start a business and you putting your $4,000 into a business for investing. Now let's look into some ways of start building wealth. Firstly, what are you good at? Do you have any special skills? If today you're an employee, maybe you can start your S quadrant small business with your initial capital and invest the returns. But the easier way is using real estate. Now you might think that if a rental property costs $100,000, then there's no way to start with $4,000. Once again, look into tax benefits and ways to buy real estate. Usually banks want 25% down payment for a rental property. That means that for $100,000 apartment you need $25,000. You can look, maybe some of your friends or relatives want to invest with you. That's one way. Other way is to look other similar investors who don't have a lot of money and buy the apartment altogether. In that way, you would own smaller stake in one rental apartment. If you want to grow your money faster, you can look for real estate, but for those that need repairs and are cheaper on the market. If you can repair the estate or know some handyman, you can increase the value of the property and refinance the loan from the bank. In our example, if the apartment is $100,000 and you can do repairs for $20,000 and can refinance it at $125,000, you can get $5,000 profit immediately, plus you have a rental apartment after it too. The tenant pays the bank loan and you have another $5,000 to look for a new fixer-upper. Cashflow Quadrant's I quadrant seems the hardest and easiest at the same time. If you know nothing about investing at the moment, we suggest you look our previous video on how to get rich. In general, investments are from low risk to high risk. Lower risk has lower returns and higher risk tends to have higher returns. Usually lower returns are government and town bonds from 0.01% to 2% yearly. High returns are bonds from big companies like Apple and Microsoft. They range from 1.5% to 4%. Usually bonds go up to 10%, but risk is going higher as well. You can invest into stocks. There are many different stock types. Dividend stocks with average return from 3 to 6%. Growth stocks can go up to 30% per year, but can go down 100% per year too. Average stock pays a small dividend and grows about 8% per year. You can invest into investment funds that buy and analyze stocks for you. Usually a group of professionals have different funds like high yield funds, growth funds, utilities funds, finance funds, etc. But more often than not, funds don't make a lot of money because of these funds fees. There are a lot of research put into analyzing investment funds' profits, and most of the funds lose money. So in that case, you're better off buying dividend stocks. Another good option is to look into ETFs, exchange traded funds. These are funds that are not investment funds, but just group of stocks combined. Most popular is S&P 500 that has average yearly return of 8%. ETF usually copy the market as a whole. Over the past 100 years the average return is 8%, so it doesn't matter when you start investing, but that you start. Usually there's a local broker who takes a few dollars exchange for buying stocks and ETFs, so you need about $10 to start. Next option is loans. There are many platforms for it. It's called P2P platforms, person to person. That's where people can give out loans to other people using local loan offices. Average returns are 8 to 16% depending on the risk. There are also B2B platforms, person to business. So same thing but with businesses. You can also loan money to people you know or local businesses for a nice 10% return. There are lots of different sites for loans. Some are focused on agriculture, some to real estate. Usually you can start with €50 on those platforms. Always make a good research before investing in any platforms. Last option is angel investing. This is investing into companies that need capital, money and knowledge to grow. These are companies, usually tech companies, that want to grow their value into billions. Some that you might know, Airbnb, Bolt, DoorDash, WeWork and such. As you can see that for years they don't make any money and can go belly up. Investing into startups is very risky because you bet on the founders more often than not. Although your returns there can be in thousands of percents, usually you need minimum $10,000 to make one investment. You can also buy paintings, rare collectibles like cars and such, or just buy gold. Those things are more focused on storing value but not increasing it. The more you know about possible investments, the more money you can make. If at the moment you need more money to build wealth, you need to earn or get more. Usually the best option is to start a side hustle, doing something on the side. So when your 9 to 5 ends, you work on your side hustle. It can really be anything, from cleaning and loan cutting to programming. It really depends on what you know and are good at. If you have no idea what to do, you can start with those that don't need extra skills. It's also important that the money you make doesn't leave the company. Kiyosaki in his early years made money in many ways and one day bought a Porsche with his hard work. All his co-workers thought that it's his father's. In reality, he never took money out of the company and kept investing it in real estate and in the stock market. If today you can save 5% of your money and keep it in your own company and invest it, it's a strong start. The compound effect makes your money grow. There's a thing called the rule of 72. That is a good thing to calculate how quickly your money doubles. I'll give you some examples. Let's say your investments grow by 8% every year. 72 divided by 8 is 9. That means it takes 9 years for your money to double. If you make 1% per year, that means it takes 72 years for your money to double. So if you aim for 10% per year, what is very possible, your money doubles every 7.2 years. But that's only the money you have invested. If you can add extra money to invest every month, it starts to grow even faster. Before you know it, you have enough money for your first real estate flip. Money kept in investments can easily grow and double with little ease. If you become wealthy, it's almost important to stay wealthy. Kiyosaki says that there are two types of problems: too much money and too little money. Both have its problems. At first it might seem weird, but let's look into it. If you have too much money, let's say $10 million at some point, you have few problems that arise. First off, you need to protect your money from your friends, family, charities, and everyone who suddenly needs money for something. Then you must fight inflation. It's usually around 2 to 4% per year. Although as of now, when making this video, it's closer to 10%. That means that your money loses 10% of its value every single year if it's not invested. If you make 10% per year, you don't get richer or poorer in that way. Getting 10% returns is not very easy either, as we looked before. That means that you are a better investor than the average or take on extra risk. You also must think about path. Will you invest your money yourself or hire someone? Who will you hire? How will you make sure to not lose everything? As you can see, there are many things to think about when you make a lot of money, but if you start small, it's easier to grow with it. Statistics show that people who fall into big money, winning a lottery or getting a big inheritance, don't know how to protect the money and what to do with it. Usually, about 2 to 3 years later, they are poorer than before getting the money. Keeping your money is as important as making it. These are the key points from Cashflow Quadrant by Robert Kiyosaki. We hope that you enjoyed the video. There are some helpful links down below. Have a great day and we will see you next time.